Well, I think then we will make a start. Good afternoon, everybody. It's great to see many friends on screen and contacts as well. So it's very good to see you. Welcome to this afternoon's webinar, which is brought to you um, by Darwin Gray and also Cwmpas on the really important issue, which is of huge interest, I'm sure, to many of you. And so we're going to be looking at this afternoon at the many facets relating to employee ownership trusts, and we'll be giving you the opportunity to ask as many questions as you think you wish to do so. I would say from the start that the afternoon session is being recorded. And can I also ask from a housekeeping perspective that you do keep your microphones on mute to avoid any unnecessary feedback throughout the event. And also, if you have any questions, can you put them within the chat mechanism, which I'm sure you're all very used to doing. So that would be great. And without further ado, it's my great pleasure to introduce you to this afternoon's panel, who are going to take us through this important subject area. First of all, can I welcome Emily Shingler, who's an associate at Darwin Gray. Emily supports businesses and organizations across a variety of sectors, including manufacturing, technology, and the third sector, and has acted on numerous transactions, including, importantly, EOTs, private equity investments, and intragroup restructures, as well as advising businesses on corporate governance matters. Emily is going to be sharing key legal considerations on employee ownership and what they mean for you and your business, including the selling shareholders, employees, and new corporate structure. Welcome, Emily. Good to see you. You can give us a wave so we can see you on screen.
Hi.
Emily. Next, I'm pleased to welcome Richard Bowes. Richard is the Director and Regional Business Development for Cwmpas. And he brings a wealth of experience within the banking and finance industry and is responsible for supporting deals across the Southwest and Wales, where he works alongside the business community delivering funding solutions for growing regional businesses. He's going to be exploring how specialist alternative finance providers like Cwmpas can fill the current employee ownership gap and successfully support the financing of EOT transactions. So welcome, Richard.
Thanks, Robert.
Martin Knight is a director of BPU Chartered Accountants, and Martin joined BPU in 2007 and has extensive experience of working with a variety of companies in terms of both size and business sector. He specializes in simplifying and presenting tax matters and regularly presents at local networking groups as well as client seminars. He focuses on helping owner-managed businesses and SMEs in a number of areas, including mergers, acquisitions, extracting funds, remuneration strategies, venture capital schemes, succession planning, raising finance, property transactions, and employee reward and attention. So welcome, Martin. Good to see you this afternoon. Paul Cantrill is a specialist EO advisor from Cwmpas, been an advisor with over 40 years experience in both the private and public sectors. He joined Cwmpas in 2009, advising companies on succession planning, incentivization, and employee ownership. He specializes in using employee ownership trusts, share schemes, and management buyouts, and he was a participant in the work following the Nuttall Review, which led to the EOT provisions in the 2014 Finance Act, and is still working with Graham Nuttall of Field Fisher, the lead advisor to the UK government on the ongoing review and consolidation of the EOT arrangements and the promotion of these arrangements as succession solutions in other countries. So a warm welcome to you, Paul.
Good afternoon, everyone.
Good afternoon. And Mark Willis is a director of Wavehill, who's actually been through the process. Mark co-founded Wavehill in the 1990s during the lifetime of the company. Mark has gained a wealth of experience working with community regeneration projects across England and Wales, leading and coordinating evaluations, research studies, community consultations, training, and large-scale surveys. And in 2020, Wavehill became an employee-owned company. This has ensured greater input, increased accountability across all levels of the business. Structures now in place to allow staff to articulate what matters to most of them and to better share in Wavehill's success. So welcome to you, Mark.
Hi.
Good to see you this afternoon. And ladies and gentlemen, what I'm intending doing is if I go around our panel, first of all, to give us an opening salvo, just a little bit about the area, so from which we can start to disseminate some questions and points that we can develop further. And Mark, as I introduced you last, perhaps I can come to you first and ask for a brief overview of why it's been so important to you and what it means to your business. Mark.
Okay. Yes, cheers for that. Thank you very much. Afternoon, everyone. Firstly, apologise for my slightly croaky voice. I went to the rugby on Saturday and I maybe tried to give them a little bit too much vocal encouragement, but hopefully you can all hear me. So just as a short introduction, really, as Robert just said, I founded Wavehill back in 1992. Wavehill's a social and economic research company. Our main offices are in Aberaeron, but we also have offices in Bristol, Newcastle and London. We employ around about 35 people. As Robert also mentioned, yeah, we transitioned to an employee-owned business in November 2020. God, I can't really believe it. It's been now two years ago, and it's, you know, the time has flown really since then. We originally considered this option towards the back end of 2019, and sort of after a period of around about 10 months of sort of consultation throughout the organization and sort of preparation, we finally made the jump. And actually it wasn't really a big jump. It sort of happened very, very seamlessly, with very, very little disruption to the day-to-day running of the business.
Great.
For Wavehill, it sort of was quite a natural progression, really, the move into an employee-owned, as it fitted well with the company's values and also provided an important solution in terms of succession. And maybe I'll talk a little bit about that later.
Right.
Now, as an employee-owned business, sort of our staff, they have an important part to play, particularly in the strategic decision-making process. And as Robert mentioned, this has led to a much greater level of staff engagement and really has improved the accountability throughout all parts of our business. It's also enabled the staff to better share in our success.
Right.
So we've been through the process and it's worked well for us. And that was down to our directors, the senior management team, but also the support we received along the way from the likes of BPU and also Cwmpas represented here.
That's a great point, I think, Mark, for us to move along. And I think there's some really important points that we can perhaps probe later with you. So thank you very much indeed for that overview. And you mentioned Paul from Cwmpas. I wonder, Paul, would you give us a little bit of an overview of where you're coming from in terms of this important subject area?
Yes, well, as you mentioned earlier on, Robert, we do a lot of work in succession planning and have been working on that for since 2009. And what we've seen really is a gradual but steady increase in interest in the use of employee trusts for succession planning. And it's been a pleasure really over the last few years to see that grow very fast. And if you look at the map of statistics for the number of transactions, what we're finding is that about 1 in 20 business sales are now involving EOTs. We're finding that there's exponential growth in the number of EOTs that are being created and used as succession tools. And one of the bonus things for me has been that not only has this led me to work with some really interesting companies such as Wavehill, but it's also led me to work with some really interesting people around the table that you have in your panel today. It's really important that people bring together the various talents that are on offer to make the most of an EOT transition. We tend to use the word transition because it usually takes a little time for things to bottom in terms of succession. But you know, we're excited by the possibilities, and we hope that some of the people attending today will decide to explore it further.
Thank you very much indeed, Paul. Martin, can I just have some opening thoughts from you, please?
Yeah, I think from our perspective, when we're sitting down speaking to clients around succession as a general area, lots of people don't feel that the typical routes of sale to third parties or management buyouts in the historic sense really fit the business for whatever reason. I think the useful thing that employee ownership has brought to the table is that hybrid model between a sale and bringing the wider staff into the organization in a more meaningful way, and just giving that alternate opportunity for the business to carry on, for the ways and values of a business that have been established to carry on as they always have with the staff's involvement. So it's a useful alternative succession that's certainly of a lot of interest to a lot of small Welsh companies in particular.
Excellent. Thank you very much indeed, Martin, for that. Can I come to you, Richard, just to give us again a brief overview for us to explore further things out of what you say?
Sure, thank you, Robert, and good afternoon again. Yeah, I'm coming from it from the funding perspective. I think the first comment I'd make is, you know, many people are not aware that actually there is a supportive and growing financing market to fund employee ownership structures, specifically trusts. Cwmpas is a specialist cash flow lender. We've been supporting these structures since inception, so 7 to 8 years worth of funding. And I think just picking up on both Martin and Paul's points, you know, adding a modest amount of debt into the transaction can do two things. It can kind of rebalance the value that the owners can take out of the business on day one, but it can also help support a transaction and make it kind of, you know, a viable alternative to some of the other exit strategies that we'll come on to talk about, I'm sure. The second point I just wanted to make is one that Paul mentioned, and indeed Mark has mentioned as well, which is engagement. You know, employee ownership structures engage employees in a really meaningful way. And what that does is it increases their willingness to kind of add discretionary effort to their daily activities. And from a funding perspective, what does that mean? Well, often that increases efficiency, it lowers costs, and it increases profitability. So, you know, in our experience, those businesses that have been through a well-structured and meaningful employee ownership trust often can be very, very profitable and successful.
Excellent. Thank you very much indeed, Richard. May I now please ask Emily from Darwin Gray just to give us a very brief overview as well. Thank you very much.
Hello.
Hello.
Hi. So I'm a corporate solicitor with Darwin Gray Solicitors, and we're a commercial law firm. So my role when it comes to employee ownership trusts, basically business owners will come to us and we will basically draft the legal documents. There's quite a lot of sort of legal documents that have to be drafted to make the transition into employee-owned companies. So this will involve setting up an employee ownership trust. It might be incorporating a corporate trustee, and also dealing with the legal paperwork for actually for the actual sale of the shares into the trust. So in a nutshell, sort of my role would be dealing with the legal side of the transaction.
Great. Thank you very much indeed, Emily. And thank you to all the panel for just giving us a brief taster, an amuse-bouche from what we're going to be talking about over the next 45 minutes or so. I'm interested. I'm going to come to you, Paul, if I may, first of all. Why are more owners thinking about employee ownership trust now? Why is it happening? Why has it become so much an opportunity?
Well, I think it's partly because when you get some impetus and some interest, you then get professional development, professionals who support these transactions becoming more interested, and it becomes like a virtuous circle, really. So more and more accountancy firms get interested, law firms, and so on and so forth, and they in their turn contribute to that development. So I think that's one reason. So the kind of the infrastructure to support these opportunities are now is now developing much faster than it was before, which allows better services to those people who are interested. I think also there's a lot of interest from the point of view of owners who are beginning to understand that it's a very flexible arrangement from their perspective. It's an internal sale in a sense, that the trust is the company's trust, and in compared with, say, a trade sale, most of the aspects of the sale are under the control of the people who are actually currently owning the business, and indeed the senior people within the business. And that appeals, particularly in a time when there are uncertainties. Being able to deal with people that you know and trust and work with day to day is very appealing. Also, once the EOT is established and it's acquiring shares, then there are certain tax advantages attached to that. And those tax advantages, which I'm sure some of my colleagues will talk about later on, those tax advantages are great in themselves, but more importantly, they've given a kind of respectability, that's the right word, to the whole concept of employee ownership. You know, HMRC and the Treasury have introduced these arrangements, and in so doing, they've conferred a kind of respectability on the employee ownership sector. So I think that's made quite a difference.
Okay, well, I'm interested to know that. Thank you for that overview of why more people are thinking about it. Mark, does that chime with what you experienced? What were your motivations?
Just to pick up to one of the point, I think the control aspect is quite interesting. Within my sector, consultancy, sellouts have normally been to very large multinational consultancy organizations, whereby maybe the owners and the shareholders maybe did very well at a sellout. However, the examples that we've looked across our sector, subsequently, the staff have been very unhappy about the process. And a lot of the original staff have actually left the organization subsequent to that sale. So again, going back to the initial point that Paul made, it is done within a controlled way. And the focus is, what is best for the organization and the employees on the longer term perspective.
Thanks, Mark. I'm guessing I'm going to come to you, Emily. Of course, from the very basics, how does an employee ownership trust work? And in simple terms, how do you set it up?
Yeah. So the employee ownership trust is essentially the vehicle to enable the company to become employee owned.
Right.
So to set it up, you essentially need a trust deed, which is usually drafted by the solicitors acting for the company. And the trust deed will establish and regulate the trust going forward. So the company is what's called the settler under the trust, and they will appoint the initial trustee. The trustee will then have to operate the trust in accordance with the rules which we outlined under the trust deed, and essentially you have to act in the best interest of the beneficiaries. So the beneficiaries will be the qualifying employees, and again the trustees will set out who will qualify as a beneficiary under the trust. So yeah, in summary, basically to set up the trust, you basically need a detailed and well drafted trust deed.
And talking about trustees, how does a company decide who will be better enabled to be a trustee?
Yeah, so broadly, a company has three main options. So they can either, so option number one is a corporate company who acts as the trustee. Option number two is like a group of individuals, or option number three is an actual professional trust company. Right. So the most popular choice, particularly for smaller companies, tends to be a corporate trustee. So that's when a new company is incorporated. So it's usually the company limited by guarantee or shares, and it's the the board of directors of that corporate entity basically will be the one who will be the people who make the decisions. So the main advantage of having a corporate entity as the trust, as the trustee, is basically it has the benefit of limited liability. So usually the trustee's liability is just limited to the value of its assets or its share capital. And also with a corporate trustee, it's easier to hold assets of the trust, such as the shares or any property, whereas a group of individuals would have to hold them between themselves. The only thing we have to be careful of when having a corporate trust company is to get the board of directors correct. Basically, you have to have a well-balanced board. So it's not uncommon for, say, a director of the actual settler company to also be a director on the board of the corporate trustee, but we also would advise having some independent directors and also some representatives of the employees on that board.
Okay.
I've just briefly touched on the other options. There is the option of having a group of individual trustees, which often can be the most cost effective, but it's generally not advisable because basically the standards imposed on trustees under law can be quite onerous. So if you have a group of individual trustees, then they could potentially be liable if any breach of duties and if any of the beneficiaries suffer any loss. So generally it's not sort of advisable to have a group of trustees. The other option is to have an actual professional trustee company. So that's where an actual firm who specialise in sort of administrating trusts. This tends to be a good option if you're a bit of a bigger company who might have quite a sort of a large pool of employees, or you intend further down the line to operate maybe like a quite complex share scheme. So essentially you're you're paying for expertise of a professional trustee. Obviously the downside then obviously it can be quite costly if you're having to pay pay for the expenses and fees for the trustee. So there's sort of three main options. The main thing is the company takes time to consider who they think would be the best trustee, and also consider it in terms of the size of the company and the number of potential beneficiaries, i.e. their employees.
Yeah, and I'm guessing it's getting your ducks in a row is the key thing, isn't it? Just and looking at the alternatives and perhaps what's right for your particular business, based on your particular circumstances, and perhaps we can develop that a little bit further. Thanks, Emily. I want to come to you, Richard, if I may. So a relatively new system, new structures, type of ownership structure, only going since 2014. But how does the funding of an EOT differ from other types of finance transactions?
I think the first point is it's conceptually different. So what we're actually doing here, perhaps, unlike funding working capital or funding fixed assets in a business, tangible things, what we're asking the business to do effectively is to fund part of the consideration that is due at completion. So there's a conceptual thing to get stakeholders comfortable that the legal structure will be shouldering the burden, if you like, or part of the burden, a modest amount of the burden, I should say, for the consideration that's due for that particular transaction. So that's the first thing I would say. The second thing I would then go on to is that because the underlying business is ultimately going to be responsible for those repayments, perhaps unlike more traditional asset-backed lending, the funding of employee ownership trusts, specific funders like cash flow funders like Cwmpas, we will spend a considerable amount of time understanding two things. And the first thing we want to get to grips with is the stakeholder management. So what does that look like post-completion for the vendors, the management team, and the employees that are involved in that? What are their roles? What are their operations? What are their potential conflicts and challenges, but also the opportunities for them to improve efficiency and grow, as I said in my opening comments. The second thing then is about the analysis of those ongoing cash flows from that business. So the business is obviously going to have to fund the consideration paid, i.e. the loan repayments that's going to be due on the piece of debt that we put in place. It's also going to be due the profits to repay the original vendor over time. but it's also then going to have to fund its working capital and any ongoing operations. So as I say, perhaps unlike a fixed asset type transaction where we're funding a property with an asset, here we're going to spend a lot of time analysing the operating profits or operating cash flows of the business. Now, as I say, that might be, particularly for newer, smaller businesses that don't use that type of finance, there's a bit of hand-holding, for want of a better phrase, to educate people in terms of how we do that. But it is a tried and tested, and it's a very modest amount that goes into these types of transactions. You would not want to overburden a structure like this with debt. So, historically, most of employee ownership structures have been completed, by reference to their own balance sheet reserves and cash on balance sheet rather than recourse to debt. But as I say, a modest amount of finance at completion can increase the value that can be extracted by the vendor, but also then look to support the transaction and the business going forward. So there's two things. There's the conceptual idea of debt supporting consideration, but there's also then the ongoing analysis and monitoring of the operating cash flows of the underlying business.
And so these are the types of information that you need to prepare
Yeah.
an application, or are there others or other things that you would need?
Yeah, it's worth touching upon that. And this is, I think, a general point, really, not just relevant to employee ownership trust, but whenever you're approaching a lender or an investor, preparation is absolutely key. And that's preparation of not just financial information, which you'd probably expect the bank or the funder to want to see, but it's also preparation of the non-financials, as I mentioned. So, from a financial perspective, working with the likes of BPU, your accountants, your advisors, to produce a set of sensible and achievable forecasts. That's absolutely key. As a funder, we want to see prudence in those numbers, and often we want to see sensitivities in those numbers, i.e. what happens if the business cannot meet those for want of external challenges, etc. Again, cash flow. Now, 12-week, 13-week cash flows are often used in this type of process to monitor the operating cash flows of businesses. That might be something that you can work with your accountants to start to devise and actually monitor the business early. Don't just produce it for the transaction. Look to be prepared and start producing some of those documents way in advance, like Mark mentioned in his opening comments, around before completion. The second point then is the non-financial information. And actually, I think historically there's a slight sort of urban myth that you only really want to share good stuff with your lenders. You want to share positive things about the business. Well, actually, highlighting the key risks in a business, in a structure, and how they are dealt with and mitigated by management team and employees is fundamentally important. And actually, it gives a real insight for a funder of how the business is managed and monitored. And if things do go wrong, the types of processes and decisions that the owners and management team would make. So preparation is absolutely key. The financials, yes, it's very, very important, but I think, the non-financial element, your business operations, your staff, your management team, supply chains, all that type of stuff, good quality detail about that is absolutely fundamental for structures like this.
Thanks so much indeed, Richard. And Richard, you mentioned Martin at BPU in your answer to that question. Martin, I wonder whether there's anything specifically you can say, and I think Paul mentioned it in his opening salvo. Is the EOT tax relief available to the sellers automatically? Is this something that you can perhaps illuminate us on?
It's not something that's automatically granted to the sellers. So as with any tax incentivized arrangement that exists, there's lots of nuts and bolts requirements to be met by the sellers, by the company, by the trust itself along the way, and considering those as you go through the process, without turning this into a technical exercise now for the sake of boring everyone on the call, and no one expect the professionals being interested in it. It's just taking those steps through one by one, making sure that all of them tick the box as far as the business is concerned, not just trying to shoehorn something in for the sake of trying to obtain a tax advantage. And subsequent to all those steps being adhered to, there is a requirement to actually claim that tax relief at the back end. So once the structure has been established, once the trusts and all the legal documents have been dealt with by the solicitors, etc., it's then ticking the last few boxes for HMRC purposes to make sure that nothing goes amiss at the back end. And that includes things like putting the appropriate words on a tax return to make sure the expected tax benefits are achieved, registering the trust with HMRC at the right time to, again, follow the process through appropriately. And, you know, these things which were new to most people, 2014, 2015, when following the Nuttall review, this became a sort of new structure. Now it's far more common, well-worn path, things that you can be led through within the process.
Thanks, Martin. I just wanted to ask perhaps a supplementary to you on this. If I'm thinking of entering into an EOT, and one of the questions that I've got would be, you know, how much is my company worth, and how much could it be sold for? Is that something that you would help with, or is that an analysis that you could support in identifying?
Yeah, there's a couple of ways that a business could be valued for this purpose. Some people consider employee ownership after having put the company on the market and not having reasonable offers for the business. Others are interested in this model purely for the way it provides the alternative benefits for the company. From a valuation perspective, there's a requirement to base the company value on what HMRC would consider to be open market value for the business. So as a book exercise, that might not be the same valuation that you would hope to achieve from a third party. It may take into account reductions in value for restrictions on shares, smaller sales than 100% to the EOT, etc. But it is something that can be agreed with HMRC. It is something that can be completed in advance. And it is something that's quite commonly undertaken by most accountants for either employee ownership type transactions or other HMRC incentivized models, such as share option schemes, where you'd be valuing a company on a similar basis.
Thanks, Martin, for that. That clears that question up for me. Mark, if I can come back to you. I mean, these are obviously what we're talking about, some of the areas that you might have considered in your journey. Can I just ask a question, really? In your experience, what are the key internal considerations prior to the transition?
Okay. Yeah, internal. Gosh. Okay. So, as we've all sort of said, EOT is quite a relatively new sort of ownership structure. So just to sort of reiterate a lot of what's been said, it's important that you yourself develop an in-depth knowledge as much as you can, and then communicate that clearly to the staff, including sort of the more intangible and wider benefits, not just the financial ones. Then you get your team of experts around you, and then you work out whether you need to finance it, etc. We were fortunate; we financed ours out of the reserves of the company, and then we had a relatively long exit over a number of years, so there was no burden placed on the company itself. And then to include that all of the staff are included within that journey of regular communication. And just on the point of valuation, we felt in order to be transparent, we used a separate firm of accountants that acted on behalf of the actual trustee. So we didn't use our regular accountants that we've been with for years and years. We just wanted some objectivity and some independence there of an organization that has gone through this process. Yeah, so that was us.
Thanks very much indeed, Mark. Paul, I mean, you've heard quite a lot of some elements from different colleagues on the webinar. I mean, there seems to be an awful lot of lot of common ground and working together and opportunities for getting a good team around you. But I wanted just to ask a couple of questions on some of the nitty gritty, really, if you don't mind me sort of probing a bit further. How can an employee ownership trust be financed to buy shares from current owners?
Well, I mean, as Rich has said, it's possible to take loan finance to support the purchase of shares from an owner, but quite often it is, as Mark has explained, done through the balance sheet of the company and through a deferred payment arrangement over a number of years, which doesn't cause the company any stress. So how this is structured is quite important, because obviously whatever mix is used, it's got to be affordable, hasn't it? So for the comfortable, at the end of the day, the company has got supreme. Without the company, nothing really matters. We've got to make sure the company survives. So putting those arrangements together is going to be critical. So making sure that the structure for the sale, the financial structure for the sale, is sustainable and can be financed is a critical part of the looking at the best way in which the arrangement can work. So that's something which one should take some time to really consider, I think, going forward.
And are there any sort of restrictions or points that you'd like to enlighten us on in terms of founders becoming involved who may wish to still be involved, or is it more appropriate to leave, or what from your experience would be the most appropriate route to follow? I guess it changes from business to business.
Well, you're absolutely right. I mean, the wonderful thing about this model is that it is very flexible.
Right.
So founder owners can exit immediately, and some do, because of their personal circumstances. It suits them to do that. Quite a few founder owners stay around. Some of them like to take key positions on the trust, for example. Emily's explained how the trust structure will work, and so obviously having a company director on there, that could be a founder of the company. So there is a number of ways in which founders can continue to be involved if they wish to be in the development of the company. Sometimes because of quite often there's a deferred element to the payment. So in other words, some of the money is not paid at completion when everything's signed, but paid over a few years out of trading profits. Because of that, it's quite common for owners to want to remain in vision, if I can put it that way, because obviously they are owed money once the arrangements are completed. So and some are genuinely concerned to ensure that their views about how the company will develop going forward are respected. We've got a company like Cwmpas, which is a TV company based up in North Wales. When they became employee owned, Dylan Hughes, who was the owner of that company, some of the key things that he was concerned about were things like the fact that this company was going to remain in Wales, because there's a whole history of TV companies, you probably know, being bought up by London and London-based companies. So that was to him very important. So ensuring that the trustees understood that he wanted that to happen was going to be quite important. So being a trustee allowed that to happen in a real tangible way, because he was there around the table, if I can put it that way.
I could see Mark nodding then.
Just to add that, yeah, I actually agree with everything that Paul has just said. I'm now exiting in 2025, my last little percentage. I then will probably go on to the board of trustees then maybe after that. But yeah, it just makes sure that I'm around a little bit just to ensure that it's moving in the right direction, and also to get my head around the fact that I founded the business so many years ago, and just a sudden sale and release probably wasn't sort of suited to me. So I just have a watching or brief, really, just to make sure that, you know, everything is moving in direction. I'll be paid out, and then the business is great then going forward.
And will that be selling shares, I presume? Selling your
That
shares?
would selling shares, yeah. So I've got a very small percentage left that then I will sell, yes, eventually.
And Emily, what is the process for selling your shares?
Afterwards, yeah.
Afterwards.
Well, afterwards, I don't benefit from any of the tax benefits because it's the only initial sale that the go. So I may benefit from entrepreneurs relief when I finally sell that amount of shares, if the business has the money in place to do it. Which, yeah.
Thanks, Mark. I'm gonna thank you for that, and I appreciate that. That's a really helpful observation. But Emily, there will be a process to go through, won't there?
Yeah. So as discussed earlier, first of all, you have to set up the actual trust, and that's done via a trust deed. And then the company then will appoint the trustee. And then the selling shareholders will then transfer their shares to the trustee, who will hold the shares on trust, and then obviously operate the trust in accordance with the trust deed for the benefit of the beneficiaries. So to actually transfer the shares, the formal instrument uses stock transfer forms, but there will also be a share purchase agreement, which is entered into between the selling shareholders and the trustee. And so that will just outline the main terms of the transaction. Usually as well, the company, so the settler company, will also be party to that share purchase agreement, because they will often guarantee the obligations of the trustee in terms of paying the consideration. So the main focus tends to be on the deferred consideration and payment mechanisms under the share purchase agreement. I think, as we touched on, it's often deferred consideration. So they will so the agreement will basically, set out dates and payment mechanisms for any deferred consideration. There will also be a number of ancillary documents, so things like board minutes and shareholders' resolutions, just to approve the transaction and to actually set up the trust deed. So basically, there's a whole suite of legal documents that is required to actually transfer the shares to the trust.
Thanks, Emily. Richard, we're kind of going full circle, really. We're looking about setting up the finance transactions, or the options in the beginning, and then obviously looking about sort of selling shares. But I'm guessing it's a continuous relationship in terms of financing structures. And many on the call today will be thinking of what are the challenges that I should be looking out for when trying to access funding. What are the
just before I come on to that, I think Paul and Mark have made some really useful points there around the gradual phase transition of ownership, and I think as a exit strategy, the employee ownership structure helps to elongate that process and make for a much more sympathetic transaction. And I think when we as funders look at those, and we see that founders who often have built these businesses from scratch, who know staff by Christian name, first name, the process in which they let the reins go can be tremendously difficult, and therefore actually at completion strolling off into the sunshine, or indeed 12 months 18 months, doesn't actually work, because there's a continuation of legacy and of culture. And therefore these type of transactions, picking on Paul points, I think are kind of much more sympathetic to both funders and indeed the employees taking them on. But coming back to the point around challenges, I think where we've seen it not work, let's touch upon that. Most of these do work, and if they're done in the right way and they're very diligent and they're very well prepared, they work. When they don't work, it's primarily for two reasons. From a funding perspective, it is a lack of preparation and diligence around the financial element of the transaction. It's a lack of communication, which I think Mark has touched on, not in his case because he funded it from reserves, but making the employees and those involved aware of some of the terms and conditions that the lending will come with, and that they're fully aware at completion of what rights and responsibilities that is placed on the business and them when funding goes in. The second thing then is about the structure and the independence of the trustees relationship. So Emily's provided a lot of detail on the optionality that can be taken forward there. But as a funder, we want to ensure, back to this point around diligence and awareness for stakeholder management, we need to make sure that there is suitable engagement from all parties post-transaction. That's the biggest risk, that once everyone's done the deal, actually, that's when the real work starts. We've now got to deliver the forecast, it's post-transaction, the employees engage, that's when we need it to be a coherent management team and it to be working. So the diligence around the non-financial elements, which we talked about earlier on the call, is vitally important. And then the trustee structure in terms of independence. And then I say latterly, the key thing is around advice. I would say that, wouldn't I? But assembling, and I think Mark touched on this, assembling a good quality team. Those that don't do that and don't do it early often leads to a protracted and ultimately much more expensive transaction. So the legal, finance, tax elements all being looked at, and indeed the operational elements of the business as well, looked at very, very early once this is decided as a viable route is fundamentally important.
Thanks very much indeed, Richard. I'm guessing the point about putting a great team around you is key to all of this. Like any successful outcome, you get your ducks in a row, as I said earlier. I know we've got 12 minutes left, and there's a number of areas that I thought I might explore, and certainly in terms of with Paul about how employees can have a genuine say in running the company, and how maybe senior managers could be incentivized. But what I'm going to do is, if I come to each of you for a final Jerry Springer thought, those of us with a certain age will understand that, but a final couple of minutes on some of the key points that you'd like to leave everybody with today, after what I think has been a really detailed and interesting and comprehensive approach to a new business structure which is coming of age. I know that we have 40 in Wales at the moment. I think, Paul, and we're anticipating, or certainly governments are committed to have.
Now,
oh, there you are. Forgive me for losing that, the number, the other one. But then, and Welsh government have looked at, are committed to doubling that by 2025. So,
Correct.
It is, as you said earlier on the rise. So if I can come to each of you for that final thought or thoughts, I'd be most appreciative. And maybe, Paul, I can come to you first then. As we've just mentioned.
Thank you, Robert. Yes, I'd like to really pick up something that Rich said, which I think was a very good comment. At the end of the day, we're talking about, we tend to be very focused on making these arrangements happen. Once you've made the arrangements, then there's life after the arrangement, and that's when things start. And of course, one of the corollaries of having more and more EOT-based organisations in Wales, for example, is that we've moved to a situation where there is a need for a much greater need for aftercare of those organisations going forward, because there are more of them. We now have 41, and I think that number is going to go up to over 50. Fairly shortly, because there are a lot of arrangements in the pipeline. So the challenge is going to be for all of the partners around the table is going to be, how can we effectively help our clients sustain the businesses which become employee owned, and how can we ensure that those businesses really do maximize the opportunity for growth and employee development.
Thanks very much indeed, Paul. Hugely important that we have a sustainable options going forward, both for the businesses, but also for the wider Wales economy. And if this structure is going to grow and grow, then we wanted to make an impact on the economy going forward. So thank you for that. Mark, I saw you're nodding.
Yeah, just sort of quickly to add to what Paul's just said. One of our challenges at the moment is to put into place mechanisms whereby employees can feedback on an ongoing basis. So communication with employees that doesn't take up too much time and take over the whole process. But just quickly on the benefits, now that we're 2 years down the track, you know, we've talked quite a bit about the tangible benefits and sort of the financial benefits, but reflecting on it now, I would say that the greater benefits to us with the intangible or the less tangible benefits. We're in the position, for example, where, you know, this model really illustrates our ambition to commit to social value. And that's an important factor for many of our clients that we supply to. So, you know, the actual less tangible benefits, but it really has had an effect on our top line and bottom line. And also becoming employee owned has enabled us to sort of embed social value more within the organization, including our commitment to environmental impact, incorporating equality, diversity, and inclusion, as well as sort of a better work-life balance benefits to our staff, and sort of has had a significant impact with regards to staff retention and recruitment. People are now seeing Wavehill as an attractive organization to actually work for. So, you know, 2 years down the line, these have come to the forefront now as really big benefits of our transition to employee owned. Thank you.
I think we could safely say, Mark, that you're a fan.
Correct.
Correct. That's it. Thank you very much for that. I mean, that's a glowing reference in terms of again, getting those advisors around you, but also importantly, making it right for your business as well, which is key. Emily, some final points or thoughts from you, please.
Yeah, again, it's just what's already been touched upon is that, you know, it is a substantial project to move your company to be employee owned. You know, there's lots of considerations from tax perspective, legal perspective, finance, and also operational. So like we've already touched on, it's important to get, you know, that professional advice early, and also seek, you know, practical advice, you know, from people like Mark, who, you know, who have taken their company down the employee ownership route. So I think it's just, you know, it's not a decision to be taken lightly. So it's important to really, you know, consider the key factors and get that advice.
Great. Thanks so much indeed, Emily. Getting professionals with the right skills to do the job. Martin, some final thoughts from you.
I think that one of the keys from my perspective is to make sure that the tax incentives and the tax breaks that are on offer are not key drivers in the transaction itself. So, you know, don't let the tax tail wag the dog, as it were. Explore all opportunities to exit the business as a vendor at the outset. So consider the employee ownership model alongside third-party sale, management, buyout, etc., etc. When you've ruled out some of those alternatives, you will get the core reasons and rationale as to why employee ownership suits the business at that point. You then can get into the nitty-gritty of how does the tax work? What structure do we put in place? Who do we consider for the trustees, etc., with the right core motives for taking that forward? And typically speaking, where you enter into a transaction for the right reasons and not purely to try and take advantage of a tax break, you're already going to meet the majority of the criteria HMRC are going to expect throughout that transaction. And for the avoidance of doubt, if tax does become part of the overall consideration, and it may be based on valuation or otherwise, perhaps I can sell slightly less to an employee ownership structure because I'm not paying tax. We can then obtain things like HMRC clearances for a bit more certainty throughout that process. So you're worrying more about the overall structure and not about ensuring that the tax requirements are met throughout the process.
Thank you very much indeed, Martin. Thanks for that. And if I can finally come to Richard, please.
Yeah, thank you, Robert. And yeah, I concur with what Martin was saying. For us, actually, and what Mark mentions, it's actually the intangibles which I think are the most important. if it's cost savings and tax that are driving transactions, those are the ones actually as a funder we're probably not going to be interested in. You know, as I said at the beginning, engaged employees are often more productive employees, which are often therefore part of more profitable businesses. So, you know, if your business has a really strong culture and there is an element that you want to pass that on and there's an effort of legacy, then I think, you know, an employee ownership trust is absolutely worth considering. The other thing I just say is, you know, these are, as Paul mentioned before, these are flexible ownership structures. They're not off the shelf. So therefore they can be bespoke and tailored to a specific type of business or industry. And therefore from a funding perspective, just because your business doesn't meet the high street lenders criteria, perhaps you're in professional or commercial services, hospitality, leisure, creative arts, that don't necessarily have a fixed asset base, that doesn't mean you can't get access to funding to be able to support the transaction. There is a, as I say, growing and supportable finance market that is more comfortable with these type of structures. So that's probably where I'd leave it.
Well, thank you very much indeed, Richard, and thank you to everybody for giving us a most interesting and illuminating opportunity to learn more about EOTs, both from experience and also from professional advice. Can I, on behalf of everyone on the call, thank Emily from Darwin Gray, Richard from Thin Cats, Paul from Cwmpas, and Mark from Wavehill, and of course Martin from BPU for your time. And also for giving us a really comprehensive overview of an important area, an important new structure, which I think over time will be increasing, as Paul said, considerably over the years ahead. It's been great to see everybody. We're 2 minutes ahead of schedule, but it's always better to be early than late as a finish. Perhaps Anna would be kind enough to either or both drop the contact details of everyone on the call today into the chat, and perhaps do a follow-up email. I'm sure Anna will be doing that, just to let everybody know how to get in touch with everybody. If there are any questions, we've talked and talked, and it's been very comprehensive, and I appreciate that. But I also appreciate your attention, and for you all for taking the time to participate in today's event. So look after yourselves and stay dry in this inclement weather, and hopefully we'll have the opportunity of seeing each other again. So once again, thank you for your attendance, thank you for supporting, and thanks to the panel for such a great opportunity of hearing about this very important opportunity for businesses going forward. Have a good day and goodbye.
Thank you.